This morning's jobs report came in worse than expected. Employers cutting 80,000 jobs last month. Are the latest data signaling a recession, he asked. Joining us, Stephen's with me on this as well. Ray Hatterman, a senior policy analyst at the Heritage Foundation, and Jared Bernstein of the Economic Policy Institute. He's a CNBC contributor as well. Well, what do you think, Ray? Tough to put a positive spin on this, isn't it?
I think it's hard to put a positive spin on what has been pretty much a lousy quarter. We've had pretty much a flat economic growth. This is the fourth month in a row that private payroll has declined. If you're looking for a bright spot, you can look at hours worked. For the first time this year, since last quarter, we did see a very slight uptick in the number of hours worked, so that it could indicate that we may be getting closer to a bottom in the unemployment report. The worrying news is that employers continue to accelerate the pace of layoffs going up, so I expect things to get a little bit worse before they get better.
Jared, what do you think? More to come or not?
Absolutely. I think we're probably about 3 months into a recession, and if we're near the bottom, it's going to be the shortest recession on record. Remember, in the last recession, after it ended, unemployment kept going up for 19 months after the official recession was over. So we are at the beginning of a period where unemployment will be climbing. Every macroeconomic forecast I've seen has higher unemployment at the end of 2008 than at the beginning, and also at the end of 2009. So, I agree with Ray that it's pretty hard to find anything but pretty gloomy clouds vis-a-vis the labor market. The recession is very solidly entrenched in the job market at this point.
Steve?
You know, it's interesting. I think Jared would agree. You wouldn't want to wait as an investor for the bottom of the unemployment report before you actually began to believe or invest in a rebound. The trouble is, I was listening to the last section, Bill, where Al Goldman was talking about, looking across the valley, and all I could think about is it's actually nighttime, and how can you actually see across the valley right now? There's no visibility in my mind about a turnaround or a rebound. I think Jared said it right, that the numbers continue, the job numbers continue to get worse. And then you had Matt Nestor on just before talking about companies whose guidance as to earnings are going down for the outlying months. So to me, I just don't see the reason why the market would begin to invest in the other side of the abyss here without any kind of visibility as to where things are going to ultimately bottom out.
Ray?
Well, I think there are a couple of sectors of the economy that remain strong and say that maybe the recession won't be as bad as some people predict. Exports remain pretty solid, so that'll help keep the U.S. economy propped up. We know that all these interest rates cuts are going to start having an effect at some point for the Fed, and so while they probably will continue cutting rates later this month, eventually that's going to trickle down. We're going to start seeing the credit crisis resolved. The housing market has got to get better in the next couple of months, so I don't see, the doom and gloom ongoing recession.
Well, let me just say this. I don't want to be the classic dismal economist here, but the interesting thing
We'll leave that to Steve.
The interesting thing is that pretty much every upside expectation, especially vis-a-vis the job market, has been dashed. You saw it last month, you saw it the month before, you saw it this month. So I would be wary of, predicting bottoms and lights at the end of the tunnel.
But, okay,
by the way, the healthcare sector is another sector that keeps on ticking.
Steve, what about the effects of monetary policy? We are starting to head into that time frame when it should be felt. The fiscal stimulus that we will get starting next month from the federal government in the forms of those rebate checks?
People need to think about this in terms of a race. On the one hand, you have the lagged effects of monetary policy, which you're talking about. On the other hand, you have the lagged effects of the credit crunch here. Both of those are going to be hitting the economy with a lag, and the question is which one wins. Looking at what the Federal Reserve has said, which is the best guidance that I can figure out, they don't think they win that race. They have spoken about easing the effects of it. They have not talked about getting rid of the effects of it.
Look,
they can do something about the pain, but they can't alleviate the disease at this point.
So what might have been a 2% decline in GDP, maybe 1.5 or 1, but that doesn't get rid of what would be a decline in GDP.
All right, I got to go, guys. I wish we had more time, but we'll see you next month.
Thank you.
See you later. Thanks, guys.